Welcome to How to Plan for Tax Efficiency in Retirement. Do you remember when you were a youngster and used to watch the Bugs Bunny Roadrunner show? Maybe you used to lounge around in your pajamas with the built-in feet on your shag carpeting. Well, I always remember there was an episode where the Wile E. Coyote was inside this shed concocting a bomb. Of course, the bomb was made by no other than Acme Bomb Company, while the Roadrunner was running around outside the shed. Hold that thought for just one moment. I need to ask you a question. Do you think taxes will be going up in the future or down? If you said up in the future, you and I are probably on the same page. So let me talk a little bit about our past U.S. tax history. So if we go all the way back to 1944, marginal rates actually reached 94%. Of course, in 1944, the U.S. had to pay for its wartime efforts. In 1944, if you're earning a couple $100,000 per year, then you were in the 94% bracket. And a famous movie actor by the name of Ronald Reagan used to be in that bracket. Supposedly, he would make 2 movies per year. He'd make the first movie and earn $100,000, make the second movie and earn $100,000, and then he'd just quit working for the year because it wouldn't make sense because all this money would go to the government. So during the 1940s and 50s, the top marginal rate was in the 90 percentile range. During the 1960s and 1970s, the top marginal rate actually was right around 70%, according to the U.S. Tax Policy Center. In 1982, no other than Ronald Reagan became our president. And one of his first actions was to reduce the top marginal rate all the way down to 50%. So now, during the 1990s and 2000s, the top marginal rate was actually right around 40%. And today, as you're going to see from our slides and the things I'm going to teach you, the top marginal rate is actually only 37%. So by 75-year standards, our rates today are somewhat lower than what they've been in the past. Now, one of the reasons why I think rates will be going up in addition to the past history of our tax rates is this thing called the U.S. debt clock. If you're fortunate enough, you might remember seeing this in New York City Times Square, or you can just look up online to see this debt clock. And the debt clock right now, our deficit is actually right around $25 trillion. And after the U.S. shut down with the coronavirus, supposedly that's going to be adding another $6 trillion to our national debt. Now, the 2 largest budget expenditures in our national debt are Social Security and Medicare, Medicaid. These 2 expenditures continue to go up because there's so many baby boomers that are reaching retirement age. By definition, a baby boomer would be somebody born between 1946 and 1964. So if you're in that age range, one of the first things you do when you retire is you apply for Social Security and your Medicare. Now, by the year 2030, 10 years from now, there's actually going to be 20% of our population that's in retirement drawing Social Security and Medicare and Medicaid. So again, we think that this national debt and national deficit will continue to go up. And the only way to make it go down, according to the comptroller for the United States government, is you have to do one of 2 things. One would be to reduce reduce spending by half, or number 2 would be to double taxes. Obviously, neither of those are very popular options with any of us, but the most likelihood is that they're going to be increasing taxes in the future. So our current tax laws actually expire December 31st of 2025, and we feel that the rates these days are fairly reasonable compared to past history and to where we think that they might need to go. So let's go back to our earlier story about Wile E. Coyote. He's in that shed concocting the bomb made by no other than Acme Bomb Company. And the Roadrunner takes that shed and pushes it onto these railroad tracks and Wile E. Coyote hears this train barreling down the tracks, and he looks in this little window and he sees the train coming. But instead of jumping out of the shed, what Wile E. Coyote does is he pulls down that little shade and goes back to work working on his little bomb. And of course, kapow! Onward to another Wile E. Coyote episode. But my main point here is this ticking time bomb that we have in our plans is things like our 401ks, IRAs, tax-deferred retirement plans that you've never paid tax on before. And in the future, what we think could happen is that it's almost like a little ticking time bomb for you. So throughout the workshop, we're going to try to encourage you to take action now in order to reduce your taxes into the future. So I have this laid out in a 5-step webinar lesson plan. And lesson number 1, we're going to talk about the current tax rate structure with ordinary income as well as with qualified dividends and long-term capital gains. So 2 separate brackets, and all of our decisions in the future are going to hinge on what our marginal tax rate is. So take good notes in this section, and again, we'll want to know what marginal rate we're in. Section 2, we're going to talk about our deductions and tax credits. And here I will teach you a few items that you could use in order to reduce your taxable income. Section 3, I'll be discussing the required minimum distributions. So this is where you'll accumulate money in your retirement accounts, tax deferred, and eventually the government is going to say, hey, we want you to pay tax on that money, and it could be at age 70 and a half, or for some of you it might be age 72 according to the new Secure Act passed in 2020, which I'll talk about. Section number 4 will look at the taxation of your Social Security benefits. So oftentimes you go, okay, well, eventually I'm going to have this nice little paycheck coming in from the government, but a lot of times people don't realize their Social Security can be taxable if their provisional income is reaching certain thresholds. So we'll discuss that. And then section 5, we'll talk about retirement income planning strategies and tax mapping strategies in order for you to pull all these ideas and concepts together to get yourself into a lower bracket in the future. Something interesting I can tell you about myself is I've been a financial planner for 30 years and actively teaching workshops and webinars, and have literally had over 10,000 students that have come through my workshops. This has really helped me stay sharp and in tune with the current tax strategies as well as financial and investment management strategies. I'm also a certified financial planner, which gives me training in over 1,000 different integrated financial planning principles in order that I might bring a more comprehensive experience for my clients. Our investment company, Summit Investment Advisors, specializes in 5 different areas. We have financial planning, which is discovering needs, wants, and wishes of our clients and what tools and techniques are best to accomplish those goals. We specialize in retirement income planning, which is basically for pre-retirees and people that are already retired, answering questions, will I have enough? Will my money last? What investments do we draw from first? Should we take out of the IRA, 401k, Roth IRA, stocks, pensions, etc.? You get it. Investment management is our third specialty. And here we are independent investment advisors. We're able to work with all the different investments, whether it's mutual funds, stocks, bonds, ETF, annuity type products. So we are licensed in those different areas. And we are fiduciaries, which means that we have to put our clients' best interests first. Of course, we have income tax planning, and there we do both tax preparation as well as forward tax planning. So there is a difference between the two. Let me describe them. Tax preparation is where you put your information in from last year to figure out if you're going to get money back or owe money in. Forward tax planning is using the tools and techniques and the steps I'm going to show you today in order to reduce our tax bill now and into the future. So we'll be looking out 3, 5, 10, 15 years now to increase our portfolio value as well as reduce our taxes. And then, of course, we have estate planning. And estate planning is once we've built this money up, how do we pass it on to our loved ones without government interaction and government taxes? So those are our 5 specialties, which I'll talk a little bit about more towards the end of the workshop. We do have some post-webinar rewards, and so stick around because we have a special gift of bonus content. And the bonus content is going to be some of the charts and graphs that I'll go through during the workshop, along with some white papers that further describe the techniques, along with a flip book that's available for you on taxation and retirement planning. Second thing is we'll offer a no obligation phone or video web review. So oftentimes you're going to have questions as we go through the workshop. And this would be a good opportunity for you to talk with a certified financial planner and have those questions answered. Otherwise, we've provided some chat availability throughout this webinar where we'll have a certified financial planner helping you with the questions as they go along. And then the third thing is we have a complimentary roadmap to your summit plan and tax analysis. So those are our rewards at the conclusion of the workshop after you fill out the evaluation form. A disclaimer, and of course this is something that we have available on our website.